Hi all. Today's session we will understand the concept of dividend and dividend yield. These are most often ignored by investors and they are oblivious to the fact how much dividend yield comes to their accounts. But dividend, understand that over long periods of compounding can form 2 to 3% of your stock returns and sometimes even more. So dividend yield, because the amount is minuscule, people really ignore that. But understand, if your target is to achieve say 20%, 25% returns and the stocks gives a price appreciation of say 18% compounded annual growth rate, the remaining 2% delta you get it from the dividend yield. So let's understand in this session what is dividend yield and how it plays an importance in the process of investing. Let's look at the slide where we talk about dividends and dividend yields. So dividends are the distribution of the company's earnings portion of it to the shareholders within stipulated time periods like quarterly, and dividends can also be paid in the form of stocks or property, but the most relevant prevalent format is cash back to the shareholders. In ideal terms, the shareholder gets a return on investment in a company in the form of dividends, which is actual returns or cash flow. Now, dividends should be looked at as a source of returns when you invest money in a stock or a company, and that is more predictable and it's a steady stream of earnings for the investors. And the other part of the earnings is because of the price appreciation of the capital. Now, companies can choose to issue dividends over different time frames, and they call it as payout rates. Usually, the term payout refers to the dividend the company is paying to its shareholders. Dividends payout can increase shareholder wealth, and usually companies which pay high dividends are respected by the markets, giving them a higher ratios, or whether price to earnings, or whichever way to look at it. Companies which are small or medium size, which are in the initial growth phase and which needs the capital to grow, they plow back the earnings into the business to achieve that growth. Whereas large mature industries, businesses which are operating become very large, and there is only so much they can reinvest into the business to achieve growth, they tend to generally give back the shareholders in the form of dividends. Dividends can also be used to arrive at valuations for a company. The dividend discount model or the garden growth model techniques rely on anticipated future dividend streams to value companies. Just the way discounted cash flow method is done, this is based on the future anticipated dividends streams which is used to arrive at the valuation. Dividend yield. Dividend yield is nothing but the ratio of dividend per share divided by current price per share. Now, for example, IBM pays an annual dividend of $2 per share and the stock trades at $100, then the dividend yield is 2%. Dividend yields should be considered as part of valuation to understand the future return potential. Even if you're doing other type of valuation, you should consider dividend yield in arriving at the future cash flow. Total return finally is the sum of dividend yield and the price appreciation over the base. Here is an exercise which is great to do, which will provide some insights and a tracking mechanism. Take your portfolio, find all the companies which are paying dividends consistently, mark them across, and see how much dividend yield you're getting from these companies over periods of time. So this is a great exercise to do, and you will realize the potential of dividend and in terms of returns for the investments over long periods of time. And that's about the dividend and the dividend yield ratios. So that brings us to the end of this session. Hope it was helpful.